had a government for 3 months now because no political group can form a majority. The political chaos and global ramifications have left Italy in a very precarious situation, as our Natalie Carney reports from the Italian capital.
Italian politics have never been simple. The current political crisis embroiling the country has caused significant concern for the EU as well as global markets. On Sunday, Italian President Sergio Mattarella vetoed Paolo Savona to serve as the country's next finance minister. The president then turned to pro-austerity economist Carlo Cottarelli to form the next technocratic government. It's a government, though, unlikely to be approved by the anti-establishment Five-Star Movement and the far-right League Party, the two parties which came out on top in Italy's March election.
This new government, Cottarelli's government, goes to the chambers and there is an overall no vote, then you see, this means that Italy does not have a government. And this means that Italy would be a very feeble negotiator on G7 in Europe and, of course, the issue of the capital market.
Cottarelli and President Mattarella met briefly on Wednesday to try and find a way out of the current situation. But according to the head of the Foreign Affairs Committee for the Five-Star Movement, the only way out is for the president to reconsider their proposal for finance minister.
We think that the only solution now is accept this government that we brought to him on Sunday with Savona, or going back to the votation. Yeah. Okay. We will not support any different government from the one that was voted by people.
The two parties, the Five-Star Movement and the League, share little in common, but do agree on limiting the European Union's hand in Italian affairs.
But electoral promises can be very different to political reality. While there's been a lot of anti-EU rhetoric coming out of the League and a lot of anti-austerity economic promises from the Five-Star Movement, there's also a lot of doubt as to what both these parties can really follow through with.
The Five-Star Movement has promised to reduce taxes and roll out universal basic income for the unemployed, a move that could jeopardize Italy's obligation to the European Monetary Union to reduce its debt ratio by 60%.
Withdrawing from the euro is extremely difficult, extremely complicated, and Italy would pay a very high price for it. So it is very clear that within the League this hypothesis has been discussed. How realistic is, if they want to do that, can they do that? Most likely they cannot.
Analysts predict the two parties will drop their insistence on Savona as finance minister in order to resurrect their bid to govern together, or the two parties will abstain from voting on Cottarelli's interim government to return some confidence to the markets until new elections are called, likely in the fall. If a coalition populist government is formed between the Five-Star Movement and the League, even if a temporary one, it will be the first in Western Europe and have lasting effects across the Union. Natalie Carney for CGTN in Rome.
Well, Italy paid the most in 4 years to sell its 10-year debt on Wednesday following a rout in its bond market triggered by political turmoil in Rome. Worries about the spending plans of an incoming anti-establishment government was quickly followed by fears about Italy's euro membership. Italy sold 5.57 billion euros in bonds Wednesday, narrowly missing the top of its targeted issuance range of 3.75 to 6 billion euros. Demand was stronger for 5-year bonds compared to the riskier 10-year issuance. The bond sales eased concerns about Italy's ability to finance itself and help bonds recover from Tuesday's astonishing sell-off. Italy's short-dated borrowing costs fell back below 2% Wednesday. Market players fear the likelihood of a snap election could be a de facto referendum on the single currency, as well as Italy's role in the EU.
It's certainly going to have a fiscal ramification for Greece if they find it difficult to get back into the government bond markets and borrow, given what's going on in Italy. But for the time being, traders are very much concerned about Italy, just because Italy is one of the core Eurozone countries. It's the third largest economy in the Eurozone. And if there's major rumblings and there's certain individuals that want to remove Italy from the Euro, that's going to have a potentially catastrophic effect.
Well, Moody's on Wednesday placed a dozen Italian banks and several major companies on negative ratings watch as the country's political problems drag on. The ratings agency said it was putting Intesa Sanpaolo, Unicredit, and Mediobanca under surveillance after already placing Italy's Baa2 rating on review for a possible downgrade over the crisis. Fuel giant Eni, postal service Poste Italiane, public TV network RAI, and gas companies Snam and Italgas were also put under negative watch. All right, now let's bring in Michele Geraci, head of the China Economic Policy Program at the Nottingham University Business School China in Ningbo, who also, of course, is well versed in the Italian economy. Michele, I want to first begin by asking you your thoughts on the five-star movement urging the Eurosceptic economist Paolo Savona to withdraw his candidacy as the economy minister. What are the chances that Savona will actually withdraw, and what does this mean for Italy finally forming a government?
Well, this is what has been debated. I've been debating over the last few hours. There is a possibility that, yes, indeed, Mr. Savona would maybe voluntarily decide not to take the job that he was offered as Minister of Finance. However, the League Party may not be so happy about it, because this is, at the end of the day, what they have received votes for. The majority of Italians, more than 50%, voted for those two parties, with the promise that those two parties would take more of a cold attitudes toward Europe. There is really not being said that they will leave the Eurozone or even the European Union. What both parties have said is that they will try to renegotiate some of the treaties so that they would be more to the advantages of Italian citizens. Because the perception now has been that both the Euro and the European Union has really not brought benefits, and in some cases have increased income disparities. There have been many loss of businesses, and people try to blame something external. That's part of the psychology. But those two parties have promised that they would try, within the framework of international treaties, to try to renegotiate things. For example, the 3% deficit cap, which from an economic and technical point of view, really has no fundamentals, has no substance. There is no reason why a country cannot cross that 3%. But this, of course, limits any potential policies that would be anti-austerity in favor of investment. So this is what the two parties want to do. Nothing dramatic, although I understand the press and the fear in the financial market tends to overemphasize those issues. So, for example, I just heard the report, far-right party. It is not really far-right. It's a party that wants to put Italians' interest first, which is what pretty much every government does around the world.
Okay. And Michele, structurally, the country has the second highest debt to GDP ratio in the EU, Italy. Youth unemployment still above 30%. It was north of 40% just a few years ago. And there is adamant opposition, like you said, to austerity measures in the populace. Long term, then, how does Italy bridge the gap between how the average Italian feels and the wishes of its politicians?
Indeed, Italy has a debt to GDP 131%, one of the highest. Austerity or investment? We do know now, after the experience with Greece, that austerity measures do not work. Even the IMF back in 2008 was pro-austerity, and then a few years later came back by saying, oops, sorry, no, austerity do not work. Investment is what works during period of recessions. And so what Italy, I believe, needs to do now is a program of good investment in infrastructure, in increasing the productivity of its workforce. And if this comes at a short-term cost of increasing debt, but in exchange for long-term growth in GDP, then we will see over the next 2 or 3 years the debt to GDP ratio coming down, hopefully very quickly. But as we know, we are discussing about social sciences. This is not maths. We need to try something because austerity has proven not to work. We haven't really tried the route of expenditure. China itself has been extraordinarily successful in building its economic model on investment. You know, almost half of its GDP has been historically investment, and GDP has grown 9.5% for many years due to of course, other reasons, but we do have an example of an economy where investment drives, and especially in recession, I think we need to take the route, and that's why I was mentioning the 3% gap. If necessary, that needs to be broken up. Now, people's faith will be restored because investment means creating jobs, creating opportunity, a little bit overhaul of the education system, the industrial system, and let's not forget Italy has a very strong industry, is a very strong export-driven economy, and so it's a little bit different. We're very different from Greece. If there were to be a little short-term increase in the debt, I think that would be compensated by a stronger GDP growth. But without investment, there is almost no way the GDP could grow.
Okay.
So we're a little bit stuck, but there is a potential way out. I'm a little bit optimistic.
Okay, optimism is good. Certainly a lot to sort out from Rome. Many thanks, Michele Geracci, head of the China Economic Policy Program at the Nottingham University Business School, China in Ningbo.